Samir, you mentioned that 45% CAGR performance for the NSE 500 2004 to 2007 and saying that that's the real bull market.
That's a bull market.
So am I to assume that you believe that this is still an ongoing version of a bull market, if you will?
So let's do numbers only. So just to give you what is a bull market. So right now, if you look at the last 5-year returns of the NSE 50, Nifty.
Yeah.
So Nifty, I think will be some 17-18% per annum. Okay. Depends on which day you start and you drop off some day there. And the market, if you do longer term, will be some 14-15. Depending again on which period you consider long term. So you are some 3% more per annum for 5 years. So that's a cumulative outperformance, let's say of 18, 20%, 17%, 15%, right? And now that 15%, if you're overvalued as compared to a longer term average, how many things will you change for that? Because it is not wild beyond limits. Just to give you a perspective of what is a bull market and what is a mad bull market, in the year 1999, the NAV of my fund, which was the Alliance Equity Fund, in the calendar year 1999 went up 280%. And our balance fund, which is now both these are Birla funds, the balance fund, which was Alliance 95, now called Birla Sun Life 95, the NAV was up 170% for a mutual fund. That is what I call a bull run. And then in 4 to 7, the annualized return of the market was 45% per annum.
Right.
And my fund went up plus minus that, which is only 60 net.
Sure.
So that is a bull run. Here, the bull run is limited to a few stocks. And those stocks, if you don't buy or you buy less of. So recently, Kotak put out a report, and Kotak is negative, as you know, on caps and all. G. Prasad must have been the author, I think, that they looked at the mid-cap 150 stocks. But they did only for 1 year, I think. And they say that 25 of the 150 stocks were responsible for more than 50% of the index moves. And some 30-odd stocks were below 10%.
Right.
So it is. Large caps haven't done great because we know the banks haven't done great, the IT hasn't done great, the traditional consumer hasn't done great.
Right.
But some other things have done well, like these oil and gas and PSUs and others. So therefore, maybe that index is okay. And then in the mid-cap index has done well. But again, there it's a bit concentrated according to at least for the last 1 year or whatever. So don't buy some of those. So our conclusion is, don't do the obvious bad things. Rest you can continue to do. And according to me, one obvious bad thing is not that don't buy IPOs, but don't buy an IPO after listing. That is height of ridiculousness, particularly when they are popping 30, 40, 50% on broadly very expensive IPO price to buy that. That is overdoing the madness.